if you thought last week was busy, you'd better put your tin hat on, because in the coming week there's going to be even more macro and company news heading our way. Top down, the big news will come in the form of the latest monthly UK manufacturing, construction and sentiment surveys, or Purchasing Managers Indices, PMIs, and they're going to come from the UK, the US, China, Europe and Japan throughout the week. Remember, there's a score above 50 is seen as good and indicative of future growth, one below 50 seen as bad and a potential warning about a slowdown or even a future recession. As we can see here, all three scores for the UK were nestled in the low to mid 50s for June, although all three fell month on month. So let's see how July panned out as businesses digested the general election result and the early stages of the Brexit negotiations. We also have the latest interest rate decision from our very own Bank of England on Thursday the 3rd of August. In June, the Monetary Policy Committee voted only 5-3 to leave interest rates unchanged at their record low of 0.25%. But since then, inflation's cooled and several members of the committee have talked more cautiously, notably Governor Mark Carney himself, so no change is the consensus expectation for this meeting. Watch for any comment on the future direction of travel, however. Now, by company, a quarter of the FTSE 100 members are due to release results, trading updates, or host their annual general meeting for shareholders in the coming week. Key names to watch include Centrica and HSBC on Tuesday the 1st of August, BAE Systems, Rio Tinto and Standard Chartered on the 2nd, Next and acquisitive drug developer Shire on Thursday the 3rd, and finally, struggling educational publisher Pearson and Royal Bank of Scotland on the 4th. For all of those big names, I suspect the biggest potential source of some fuss will be oil major BP when it publishes its second quarter results on Tuesday the 1st of August. As we can see here, BP shares have been a slave to the oil price over the past year, which I guess makes sense, at least in the short term, although the company's cost-cutting and efficiency programs can help to maximise its returns and minimise the downdraft when oil prices rise or fall. In fact, as we can see from this 20-year chart, the relationship between the share price and oil is pretty strong, so it will be interesting to see if Brent crude can hold its ground back above the $50 a barrel mark. So far, so easy, you may think. Predict the oil price and nail BP's share price. Not so fast, say I. First, because the past is, as we all know, no guarantee for the future. And second, because fathoming where the oil price goes is the devil's work. On this front, what I would say is, don't get too hung up about demand. It's growing slowly and steadily as these figures from the International Energy Agency show in millions of barrels a day per quarter. Yes, I hear you cry, what about electric cars? Yes, they are an issue, but they're still expensive. There's no infrastructure in place to charge large numbers of them, and governments will probably move slowly here so as not to upset voters who will have to get rid of their cherished gas guzzler. I suspect the internal combustion engine could be around for just a little while yet. So if the issue isn't demand, it is therefore supply. And at least you can track some key data for yourself here for free on the internet. First, you want to see a slowdown in growth in rigs actively drilling for oil in the USA and especially onshore for shale. Second, you want to see a slowdown in the growth in rigs actively drilling for oil outside the USA, and that means OPEC and Russia sticking to their planned production cuts too. Third, you want to see US stockpiles of oil coming down, and recent reductions here are helping to support crude prices. So, that's the big picture. And generally a higher oil price will tend to help BP's profits. When it comes to the second quarter figures, BP will steer you towards looking at the replacement cost profit before tax, which excludes the change in value of inventory to try and smooth out some of the effect of movements in oil and gas prices. In the second quarter of 2016, BP made a replacement cost loss of $2.2 billion, as the company set aside a final $5.1 billion provision to cover costs relating to that 2010 oil spill in the Gulf of Mexico. You might therefore want to give BP the benefit of the doubt and look at the adjusted replacement cost number, which was a $1.2 billion profit in Q2 2016. The final graphic shows the quarterly progression for both figures going back to 2014. Beyond the headline profit figures, do keep an eye on the quarterly dividend, expected to come in unchanged at 10 US cents, and any comments on net debt and cash flow. Remember, BP's dividend comes to around $1.2 billion a quarter, and capital investments more than $4 billion. So profits aren't big enough right now to cover both. So the company's having to sell assets, cut spending, and potentially raise debt to fund the dividend payout. Capital investment last year was $18.4 billion, and net debt ended the year at $35.5 billion. Thank you for watching, and I look forward to seeing you next time.